The industry is not only seeking a cut in income tax rates in the coming budget, but also rationalization in the much reviled securities transaction tax. This comes on the heels of an earlier Business Today TV report that the government is having a relook at the capital gains tax. Business Today managing editor Siddharth Zarabi spoke with renowned chartered accountant Vaid Jain for more on this.
I'd say to simplify it in the best possible way, my proposal would be that less than 2 years is a short term and beyond 2 years is a long term. That's so simple. We don't make any distinction between any asset, movable, immovable. We simply say if you have held the capital asset for a period of more than 2 years, then it is long term and then it was a short. So simple, the formula should be clear on that part. And in case it is a long term, then the tax rate will be two rates. One, productive and non-productive. If it is a productive investment, then 10%. If it is non-productive, then it is 20%. That's a flat rate. And for a short term, no concession, straight away 30%. That's the rate should be there. I believe ideally that can be the best model for the taxing the capital gain, what we think about it. Because short term, by and large, is not really a capital gain. You make money by churning out. That's why it should be flat rate of 30%. There's no reason why concession rate should be applied to capital gain, short-term capital gain.
I want you to quickly explain one point. In terms of the rates, at this stage, do you see the need to increase the rates or unify them and moderate them?
See, idea is, I believe, to simplify and to remove complexity in the capital gain tax structure, rate of capital gain. I don't think that's the idea. And that, I think that in the way back, I think 2018, we have already done that exercise where we have taxed the now capital gain arising on the listed share. I don't think the objective at present looks to be to increase revenue. What can be an idea? Indian model has to be different than the advanced country. We must keep this in mind, developed nation, because US and Europe follows a different model, and they do not allow you, if you to carry over the increase in value as we do in India. If you have sold one asset and you have invested in a new asset, the capital gain gets fully exempt. That we have not followed the model in US and Europe in that way. Because India still being a developing nation, we need a large chunk of investment.
Okay.
And if it's a large chunk of investment, not only from FDI, FII, but from the Indian investors, small saving investors. So we need to encourage people to come more and more to the capital market. So we cannot follow that model of developed nation. That's why I said that in case it is more than 2 years, let's have a concession rate of tax, and that encourage people to invest more and more in India. That's the idea basically.
With the India-Australia Free Trade Agreement in the bag after ratification by the Oz Parliament, all eyes are now on the free trade deal with the United Kingdom. The deal was to have been signed before Diwali, but political instability in the UK prevented it from happening. Kevin McCall of the UK India Business Council spoke to Business Today TV about the road ahead.
What is the latest update when it comes to the trade agreements? Now, we're being told that there are going to be meetings lined up next month. What are you picking up?
Yeah, no, that's absolutely right. As you said, the two Prime Ministers met in Bali last week and they've reaffirmed their commitment to doing a deal. I think the negotiators are working, urgently towards a conclusion. And I think it's fair to say that there was a lot of noise around Diwali time. There was expectations that a deal would be done by Diwali. But I think if we take a step back, what the government's actually agreed to do back in April was to complete the majority of the talks by the end of October, which they've done. So 14 of the 26 chapters have been provisionally closed, and now the negotiators are continuing to work at pace to try and close off some of the stickier points that are there in the negotiation. So hopefully with the urgency and the pace that's in the discussions, we will see a deal emerge that's both comprehensive in terms of sectors, so goods and services, and doesn't take us too far into the future in terms of the deadline. We want to see something happening in the near term, but we don't want to rush something just for the sake of speed. We want to take our time and get a deal that's comprehensive. Okay.
Kevin, you did talk about deadline, which we'll come to later, but what was this delay about? Was it an administrative delay, or was it because of course, the political developments in the UK?
I don't actually think there was a delay. As I said, the joint statement from both governments when the PMs met in April was to aim to complete the majority of the talks by the end of October, which they actually have done.
But we were looking at a signing ceremony close to Diwali.
That was never formally stated by the governments. The aim was to complete the majority of the talks by Diwali, which they did. And I think, as you rightly indicate, there's been changes in Prime Minister in the UK, and some turmoil since sort of June, July time. But for the negotiations themselves, I don't think that actually impacted the negotiating teams, because back in January they were given a mandate by the cabinets from both countries. So the negotiators continue to work to that mandate. And it's only as we approach this period now where we're bumping up against the edges of the mandates, that's when the politicians have to re-engage and to try and do some of the political negotiating that will help us to land a deal. So I don't think the changes in the Prime Ministers in the UK over the last 6 months have actually derailed or slowed down the negotiations at all. But it is now the point, perhaps after the next round of negotiations in December, that's, I think, when politicians may have to get more engaged in the process.